Hey everyone, and welcome back to the channel. Today, we're diving into the latest buzz around the US economy, the upcoming third quarter GDP numbers. So, what's the story? After a bit of a bumpy start to the year, with the economy actually shrinking by 0.5% in the first quarter, it looks like things have really turned a corner. The big expectation is for a growth figure of around 3.2% for the third quarter. Now, you might hear that and think, wait, isn't that a little lower than the last reading? And you'd be right, but let's put that in context. A 3.2% growth rate is still incredibly solid. It shows that the US economy is not just growing, but it's growing at a healthy and sustainable pace. Think of it like a marathon runner finding a strong, steady rhythm instead of just sprinting in short bursts. So, if growth isn't the main worry right now, what is? Well, the conversation in economic circles has really shifted. The spotlight is now firmly on the labor market. While the overall economy is expanding, job growth has been a bit sluggish. This is the puzzle that economists and policymakers are trying to solve. Why isn't the strong economic growth translating into more jobs more quickly? This brings us to the elephant in the room. The Federal Reserve, or the Fed, and what they plan to do with monetary policy. The Fed has a dual mandate: to keep prices stable and to achieve maximum employment. That weak labor market we just talked about, it's a huge factor in their decision-making. For months, everyone has been speculating about when the Fed will start to raise interest rates. They've kept rates near zero to help stimulate the economy during the recovery. But as the economy gets stronger, the thinking is that they will need to start normalizing policy to prevent things from overheating down the road. However, the tepid employment situation is giving them pause. The Fed has been very clear that they want to see substantial improvement in the job market before they make any major moves. So, while this strong GDP number is great news, it doesn't automatically mean a rate hike is just around the corner. The Fed will be looking at this data alongside the employment reports, wage growth, and inflation figures. Essentially, the US economy is in a fascinating spot. We have robust growth on one hand, but a cautious central bank on the other, all because the job market is still playing catch-up. This upcoming GDP report will be a crucial piece of that puzzle, confirming the strength of the recovery, but also highlighting where the focus needs to be for the coming months. What do you think this means for the markets and for your wallet? Drop your thoughts in the comments below. Thanks for watching. And if you found this breakdown helpful, be sure to hit that like button and subscribe for more economic insights. See you in the next video.